In March 2025, the SEC dropped its final appeal against Ripple. By November, spot XRP ETFs were trading on NASDAQ and NYSE Arca. By March 2026, institutions had moved over $1.5 billion into regulated XRP products. Most coverage still frames this as a price story, but that reading misses the actual shift. The real question is whether a digital asset with unique legal clarity can function as the settlement infrastructure institutions have been trying to build. The problem most people miss. Most conversations about digital assets get stuck on price. That's the wrong frame for understanding what moves systems at the infrastructure level. The more important question is whether the protocol can do something that existing infrastructure simply can't, and whether institutions have a reason to build on top of it. For XRP, that architecture is legal clarity. Most major digital assets in the United States still operate in regulatory gray zones where classification battles create operational risk for institutions. An institution can't build settlement workflows on an asset that might be reclassified as a security next year, because that reclassification would freeze liquidity, complicate compliance, and invalidate the payment rail. That uncertainty is why correspondent banking still relies on pre-funded Nostro accounts. It uses multi-day settlement tops, so banks can clear payments without depending on assets whose legal status is unresolved. The system still works, but it's expensive, slow, and increasingly mismatched with a world where regulators and market infrastructure players push for same-day settlement. DTCC, Project Ion, Euroclear, and JPM Onyx are all experiments in compressing that gap towards zero, and they share a common requirement. The settlement layer must be legally predictable. XRP occupies a different position because a federal court ruled in July 2023 that the token itself isn't a security. The SEC dropped its appeal in March 2025. By late 2025, spot ETFs were trading on regulated U.S. exchanges. That sequence didn't happen by accident, and it points to an analytical gap that most price-focused coverage ignores. A digital asset with judicially grounded legal clarity can compress settlement risk in cross-border flows, and it can do so at the scale that same-day settlement mandates are starting to demand. The distinction between speculation and infrastructure comes down to use. Utility assets earn their value through use, and speculative tokens earn their value through expectation. That distinction matters more than most people admit, and it's why the legal status of the underlying asset is the first filter that institutional compliance teams apply before any technical evaluation even begins. There's one detail from the ETF data that most coverage missed entirely, and we'll walk through it once the legal framework and the mechanics are clear. The ruling and the transaction-specific framework. The story of XRP's legal clarity begins in December 2020, when the SEC filed a complaint against Ripple Labs, alleging that certain sales of XRP constituted unregistered securities offerings. The case centered on the Howey test, which asks whether money was invested in a common enterprise with profits expected from the efforts of others. Ripple argued that XRP itself wasn't inherently a security, while the SEC sought a broad ruling that would treat the token as a security in connection with Ripple's activities. On July 13, 2023, Judge Torres issued a summary judgment that examined three categories of Ripple's XRP distributions separately, taking a transaction-specific approach rather than declaring the asset a security or non-security in all contexts. For direct institutional sales to sophisticated investors under written contracts, the court found investment contracts. For sales on digital asset exchanges, where buyers lacked privity of contract with Ripple, the court found no investment contracts. For employee compensation and grants, the court similarly found no investment contracts. That three-part framework is the critical holding, and it has implications that extend far beyond Ripple's own fundraising. Judge Torres explicitly rejected the SEC's argument that XRP should be treated as a security in and of itself. She drew an analogy to the orange groves in the original Howey case, noting that the groves weren't themselves securities, even though the investment contracts through which they were marketed were. In the same way, XRP as a token can be involved in transactions that qualify as investment contracts. But the token isn't inherently a security in every context. For a treasury desk, that distinction is operational. Acquiring XRP on an open exchange to use in a payment flow is a different legal category from buying it directly from Ripple under contract. That boundary is what makes the bridge asset model legally viable. It means that if an institution uses XRP as a bridge asset for payments or treasury operations, rather than as a speculative investment linked to Ripple's promotional efforts, the court's reasoning suggests that such activity falls outside the securities classification that applies to Ripple's historical institutional sales. That doesn't eliminate all regulatory considerations, but it does separate the legal treatment of Ripple's fundraising from the ongoing functional use of XRP as a payment asset. The subsequent remedy phase reinforced this boundary. Judge Torres rejected the SEC's disgorgement theory because the agency failed to demonstrate that any investor was actually harmed by Ripple's institutional XRP sales. The court imposed a civil penalty of approximately $125 million, far lower than the SEC's requested figure of $876 million. The court also issued an injunction barring Ripple from future unregistered institutional sales, requiring the company to make sure that any future direct sales either comply with registration requirements or fall within valid exemptions. By March 2025, the SEC had ended its appeal, and generic listing standards for commodity-based cryptocurrency exchange-traded products compressed what had been a 240-day individual review process to approximately 75 days. The legal overhang had ended. For institutions, that meant the first filter, legal predictability, had been cleared. How XRP functions as settlement infrastructure. Start with the problem that XRP was built to address. When a New York bank needs to send a payment to a Mexican bank, the money typically moves through a chain of correspondent banks. The sending institution maintains a pre-funded Nostro account in Mexico, so it can clear the payment locally. That capital sits idle, often for days, while the message hops through multiple intermediaries. The result is slow settlement, trapped liquidity, and counterparty risk at every step in the chain. Ripple's On-Demand Liquidity, or ODL, replaces that model with a direct bridge. The sending institution converts fiat into XRP at the origin, transmits the XRP across the XRP ledger, and converts it back into fiat at the destination. The entire process settles in seconds rather than days, and the institution doesn't need to pre-fund foreign accounts. XRP functions only as a transient bridge asset in this workflow, and it isn't held long-term by the end customers. Here's what that looks like in practice. A corporate treasury in London needs to send payment to a supplier in Singapore. In the legacy system, that capital sits in a pre-funded account for days, while messages bounce through correspondent banks. Using ODL, the Treasury converts pounds to XRP, sends it across the ledger, and the supplier receives Singapore dollars in under a minute. The XRP itself is held for seconds, not days. The ledger reaches consensus and closes in approximately 3 to 5 seconds, at which point all validated transactions become final and irreversible. This property, called finality of results, means that once a transaction is included in a validated ledger, it can't be rolled back through chain reorganizations or probabilistic settlement dynamics. For financial institutions focused on payment obligations, this kind of strong finality is critical because it reduces operational risk and enables precise intraday liquidity management. The ledger also supports atomic cross-currency payments through built-in pathfinding. When an institution initiates a payment from one currency to another, the ledger's logic can route the transaction through order books and bridge assets, such as XRP, executing the conversion in a single atomic operation. The entire cross-currency payment either succeeds with all conversions or fails entirely, which eliminates the risk that one leg of a trade executes while the other doesn't. That atomicity is crucial for institutional reliability. RippleNet, the enterprise payment network that sits on top of the XRP ledger, is fully ISO 20022 compliant. The swift migration to ISO 20022 messaging finished in November 2025. And that standardization matters because it allows institutions to embed rich payment data into every transaction. When a payment message carries the amount, the purpose, the counterparty, and the regulatory context, the receiving system can process it automatically rather than manually. RippleNet's participation in that standard means that institutions using XRP as a bridge asset can speak the same data language as the rest of the global banking system. Over 300 financial institutions now use RippleNet according to industry reporting, and the network's integration stack includes APIs for banks and payment companies that handle messaging, liquidity management, and compliance onboarding. That technical and legal stack turns a token into a candidate for institutional settlement infrastructure. The protocol works and the legal status is settled. What remains is whether institutions will migrate real payment volume onto these rails at scale. The capital validation, the legal and technical foundation, would matter less if capital weren't already positioning around it. The ETF wave that began in November 2025 is the strongest signal that institutional investors are treating XRP as a distinct allocation rather than a speculative side bet. Canary Capital's XRPC debuted on November 13 and became the most successful ETF launch of 2025 by first-day trading volume across any asset class. Bitwise followed on November 20th. Grayscale launched GXRP on NYSE Arca on November 24th, and Franklin Templeton and 21 Shares followed shortly after. By December 16, 2025, cumulative inflows had crossed $1 billion. By early March 2026, that figure had grown to over $1.5 billion across 5 U.S. spot XRP ETFs, with more than 769 million XRP tokens in custody. The ETFs recorded 0 net outflow days in their first month, even as the broader crypto market weakened. That persistence suggests institutions are making considered allocation decisions rather than chasing short-term momentum. What makes the inflow data more interesting is the composition of the holders. In March 2026, Goldman Sachs disclosed a $153.8 million position in spot XRP ETFs through its fourth quarter 2025 Form 13F filing. The allocation went across 4 products, approximately $40 million in Bitwise, $38.5 million in Franklin Templeton's XRPZ, $38 million in Grayscale's GXRP, and $36 million in 21 Shares Toxer. That breadth is the important detail. A concentrated position in one product might signal market making or a speculative punt. A structured allocation across 4 issuers signals a deliberate investment thesis. JP Morgan has forecast that XRP ETFs may attract between $4 and $8.4 billion in first-year inflows. Whether that materializes depends on market conditions, but the early trajectory has done nothing to undermine that thesis. Grayscale's commentary reflects the same framing. Institutions are drawn to the payments use case, the under 5-second settlement finality, the cross-border liquidity role, and the integration with RLUSD as a regulated stablecoin layer. XRP is being treated as a utility-first digital asset rather than a pure store of value play. That utility is showing up in network metrics. The XRP ledger has processed over 4 billion transactions since its inception. Daily transactions hit 3 million on March 15, 2026, a threefold increase from mid-2025 averages, driven by automated market maker pools, tokenized assets, and RLUSD-denominated settlement flows. Real-world asset tokenization on the ledger has grown to over $474 million, with total represented value approaching $1.5 billion. When Goldman Sachs allocates nearly $154 million to XRP ETF products while the network processes record transaction volumes, the signal is hard to ignore. The capital validation isn't the end of the story. It's the confirmation that the legal and technical prerequisites have been met. The ETF inflows, the futures market depth, and the institutional holder base all say the same thing. The infrastructure is ready, and the capital is positioned. But positioning in one jurisdiction isn't the same as global adoption, and the regulatory map outside the United States tells a more complex story. The global map and what comes next. The United States is only one jurisdiction, and global settlement infrastructure doesn't run on a single country's legal framework. Japan offers a useful point of comparison. The country's financial services agency has publicly stated that XRP isn't considered a security under Japanese law, and instead classifies it as a cryptocurrency treated similarly to Bitcoin. That categorical clarity allows Japanese institutions to engage with XRP under existing crypto asset regulations, rather than navigating ambiguous or overlapping securities rules. Japanese financial institutions have been early experimenters in blockchain-based payments, and the FSA's position reinforces that XRP can function as a bridge asset, under rules that institutions can navigate. The divergence between the US and Japanese approaches illustrates both the challenge and the opportunity. Institutions with American exposure must ensure compliance with the transaction-specific U.S. regime. But jurisdictions like Japan that classify XRP as a non-security may become hubs for liquidity and ODL usage, enabling institutions to build payment corridors under clear local rules. For global banks, this means regulatory mapping across corridors rather than a single global standard. Central bank experimentation adds another layer of institutional comfort. The Royal Monetary Authority of Bhutan partnered with Ripple to pilot a central bank digital currency using a private blockchain based on Ripple's technology. The pilot explores how a digitized national currency can support cross-border payments and domestic settlement. It doesn't use XRP itself as the CBDC, but it does validate the architectural principles behind the XRP ledger, such as fast finality, scalability, and cross-currency capabilities. A central bank willing to test Ripple's infrastructure for sovereign monetary projects signals a level of trust that extends beyond purely commercial use cases. Back in the United States, the product landscape is still evolving. RLUSD, Ripple's stablecoin, has reached a market cap above $1.5 billion and is live on major exchanges with XRP ledger support. As RLUSD grows as a payments instrument, it deepens XRP's role as the bridge asset in those flows. The Junius Act and the Clarity Act remain pending in Congress as of mid-2026, with hearings scheduled that could define how payment-focused digital assets are treated at the federal level. Those statutes wouldn't replace XRP's judicial clarity, but they could make the operating environment more predictable for institutions that need statutory certainty. The structural implication is that legal clarity isn't the finish line, it's the on-ramp. The protocol is built, the capital is positioned, and the regulatory framework in multiple jurisdictions is supportive. The real bet now is whether institutions will migrate enough payment volume onto XRP-based rails to justify the infrastructure investment that has already been made. That's a volume question, not a legal one, and it will be answered in the settlement data over the next several years. If the migration happens, XRP's role as a bridge asset for T+0 settlement becomes self-reinforcing. More volume deepens liquidity. Deeper liquidity attracts more institutions, and more institutions create the network effects that make a bridge asset indispensable. If the migration stalls, the infrastructure remains technically sound but economically underutilized. Either outcome is worth watching, because it will tell us whether judicial clarity alone is enough to transform a digital token into a piece of global financial plumbing. Conclusion: XRP is no longer a speculative experiment waiting for regulatory permission. It's a protocol with judicially grounded legal status, institutional capital backing it, and real transaction volume flowing through it. The system that was supposed to stay experimental is becoming the thing institutions quietly bet on. If this kind of structural analysis is useful, subscribe, because the next video connects XRP's bridge role to the broader regulated liability network architecture.